Thomas Castelli joins me here today, and you could learn about what his team is up to by going to therealestatecpa.com/Thomas. That's going to be a clickable link in the show notes. And you can imagine we're not just talking about CPA work, but we're talking about taxes, the importance, that ever never ending.
Yep.
So I always have to start off, Thomas. How did
Yeah.
you find your way into this?
So I found my way into it because when I was in high school, I wasn't really planning to go to college, but my friends, my parents, my guidance counselors all funneled me into that direction. When I got into school, they said, "Hey, look, if you're going to be going to school for business, you have to either go for accounting or finance because that's kind of where the value in business school is." So that's what they told me. And my aunt had been a CFO for a while. She was doing very well for herself. So I jumped into the accounting field, and that's how I kind of got involved.
So, most people that listen to the show are still trying to make their way or deciding to invest in real estate. And sometimes it's important to talk about the strategies associated with it. And I don't think we've done it for quite a while, but could you start things off by tackling the big, broad concept of the tax benefits associated with investing in real estate?
Yeah, absolutely. So real estate is one of the big benefits of investing in real estate. Uh, it are the tax benefits. Say you have a job or a business that you're actively running. You're going to be taxed at the federal level up to 37%. Plus, in most states, you're going to have some state tax. And then you're going to have FICA if you have a job, or you're going to have the self-employment tax if you're self-employed. And that could easily put your tax rate between 40 to 50% if you're at the top. Right. So that could be problematic for people. And it's very painful. I've worked with a lot of investors who you just see the pain on their face when they pull up their tax return. They realize how much money they're paying in taxes. However, where real estate comes in, real estate, you have the ability to shelter your income from tax thanks to a non-cash expense called depreciation. So depreciation tracks is a theoretical expense that tracks the deterioration of your property over time. And what that does is it actually reduces your taxable income without necessarily reducing your cash flow. Let's just say you have a rental property, and let's just say maybe it's a multifamily property or commercial, whatever, and it's generating $100,000 in rental income per year. Now, let's
Mhm.
just say that you have $45,000 in operating expenses that actually leave your pocket. So you're talking about property management fees, insurance, interest, so on and so forth, repairs and maintenance. So that would leave you with about $55,000 of net income in most businesses, and I'm simplifying this here, but you have about $55,000 in net income, which you'd be paying taxes on. But now let's just say you have a $60,000 depreciation expense, which is not uncommon, especially in the first year that you'd buy a property. Well, now you have a taxable loss of $5,000. So the first thing this does for you is you didn't pay tax on that $55,000 of cash flow. So it sheltered that. Then from there, the $5,000 loss, that can be used in a myriad of ways depending on whether you're passive or you're more active or full time in the business. And I could break that down further if we want to go to, but that's one of the big tax benefits. And there's a few other ones, like, for example, the 1031 exchange, which allows you to sell your property, buy another property, usually a bigger, a larger property, or perhaps multiple properties, and defer your capital gains tax. So, if you sold the stock for the most part, you'd have to pay tax on that stock. And if you're at the highest tax bracket for capital gains, it's a long-term gain. You're looking at 20% plus potentially the net investment income tax of 3.8%, or it's 3.8%. But you're looking at 23.8% almost you're paying on taxes. You could defer a lot of that with a 1031 exchange, and you can do that over and over and over again. There's another benefit that if you buy a property, you're able to increase its value, or you hold it for a while and the value increases, you could do a cash out refinance on that property, keep the property without having to sell it, and tap into that equity you have built up over time. So there's a tremendous amount of tax benefits to real estate, which are either non-existent or very hard to do with other asset classes.
Are you one of the real estate professional status, the reps?
I'm not a real estate professional, but I'm happy to go over it. Major.
Yeah, could you talk a little bit about that? Because one of the things that I wanted to point out is that there's a number of firms that they might try to help you with real estate investing, but unless they are familiar to the level you are and actually work on this type of thing on a day-to-day basis, you may not be getting the being able to leverage that expertise like we probably need to.
No, absolutely. So this kind of goes into that $5,000 loss that we were talking about, and this loss could be much higher thanks to something called bonus depreciation, which accelerates your depreciation expense. So it's not uncommon to see people have, $50,000 loss on a property the first year. Now, the problem with that is, thanks to the Tax Reform Act of 1986, it made all rental activities passive by default. So what does that mean? That means that this rental loss that we're talking about here, this theoretical five or $50,000 loss, just to kind of keep it juicy a little bit, maybe a little bit more enticing. But what happens is that can only offset other passive income or gains from the sale of other passive activities, which is rental real estate or perhaps businesses that you're invested in. Say it's like a limited partner, maybe your friend's pizzeria, the proverbial pizzeria that your friend starts, you give them the money, you don't do anything, it's passive for you. So you could take the losses and offset that income. Now, with the real estate professional status, it's a carve out that says that if you work primarily if you work full time in real estate, to qualify, you need to spend 750 hours and more than half your total working time in a real estate business. If you can meet that requirement, that loss you have now, this five or $50,000 loss, is now quote unquote non-passive, which means it can offset the W-2 income or active business income that you might be that you might have. And this could be powerful because if you're a high income earner, like we see it all the time with like doctors, like who they're maybe in that 37% tax bracket. If they can take that $50,000 loss and use it to reduce their taxes, they're saving on that $50,000 loss, $18,500 at the federal tax level. So that could be quite powerful. However, there's a lot of room for abuse in this area. And basically, through the IRS audit techniques guide, their ATG. So this is how their field auditors audit people. They assume that if you have a full-time job, that you are not a real estate professional and you have to overcome this hurdle. And basically nobody is able to ever prove that. It's very, very low chance. And this goes all the way to tax court. There's hundreds of tax court cases, many of them having to do with W-2 employees trying to qualify for the real estate professional status. And all but one case did someone ever win. So if you're doing this, you have to truly be full time in real estate. Chances are you're not having a W-2 job. The good thing about it, if you're married, you're filing a joint tax return, if one spouse can qualify as a real estate professional and the other one can't, well, you're both basically a real estate professional for all intents and purposes. So you see a lot of times you might have a doctor or an executive, they might have a high income, but then their spouse doesn't work or maybe works part time. They are able to qualify for the real estate professional status, and now they're both benefiting from it. So while it is super powerful, it is challenging to qualify if you're not really in the business of real estate full time. However, there's the strategy where your spouse might be able to do it and you can both benefit.
Yeah, that's really good that you pointed that out because the real estate professional, I think a lot of people get into real estate investing hoping that they can take advantage of those tax benefits. You're really going to have to watch it and find somebody who knows what they're doing.
Yeah. Well, I mean, there's a silver lining in this, and there's two things I could point out. So, I've worked with hundreds of investors at this point, and sometimes when they find out that they can't use the real estate professional status, they get defeated. Like, the entire reason I came into this was so I could use this to reduce the tax on my W-2 income. But I'd encourage people to take a longer term view, a 10-year view, or maybe even longer than that. And you could play the passive activity loss game. And that is what happens is, remember the losses I talked about before, they're going to be passive by default. However, in that example with the $100,000 rental income, $45,000 expenses, $60,000 of depreciation expense, that $5,000 loss, you just generated $55,000 of income for tax free. And if you do this over time and you keep investing in passive investments, your cash flow that's sheltered from tax can keep increasing over time. And that's going to decrease what's known as your effective tax rate. So your effective tax rate is your total amount of tax divided by your total amount of income. So let me just give a quick example. It's going to be oversimplified. So if there's any CPAs tuning in right now, I don't have a progressive calculator here. I'm just going to do a simple example. Say you're making $500,000 for the year, a 37% tax bracket. You're going to be paying $185,000 at the federal level. But now let's just say that over a period, let's just say 5 or 10 years, you're able to generate $100,000 tax free, right? Thanks to rental income, right? So now your total income is $600,000, but your tax is still 185,000. So your effective tax rate for the simplified example with the $500,000 is going to be 37%. But now we're going to take that same 185,000, we're going to divide it by 600,000, and now your effective tax rate is 30%. So in other words, your tax rate is decreasing relative to the amount of income that you're making. And this is a little bit of a longer term play, but we see some of our most wealthiest clients doing this. You don't have to be a real estate professional to use. So I don't want people to overlook this aspect of real estate investing. It's not the sexiest form of doing it, but if you zoom out, you're able to see that it can be quite powerful.
Hmm. Yeah, that's really interesting. You mentioned accelerated depreciation. Can you go into detail a little bit about that? What you mean by that and how somebody could maybe take advantage?
Yep, absolutely. So when you buy a residential property, let's call it a single family home or perhaps a multifamily property, that's going to be depreciated over 27 and a half years. So let's just take a quick example. If you had a $500,000 property, land is never depreciated. So let's just say that 80% of that building, that value is dedicated to the building. So that means over four, that's 400,000, and over 27 every year for 27 and a half years, you're gonna get roughly $14,545 of depreciation. Now, if you have a commercial building, it's depreciated over 39 years. So it's actually gonna be lower than that. However, there's something called bonus depreciation, which allows you to accelerate the depreciation on components of the property that have a class life or a depreciable life of 20 years or less. So typically what you'll do is you have a property. Now I'm going to give an example of this, but typically you'll have a property. You'll have what's called a cost segregation study performed on that property. And a cost segregation study is where an engineer comes down to your property and classifies each component of it and gives you a printout and says, okay, here's the amount of your property that's 27 and a half year property. So that's going to continue to have to be depreciated over 27 and a half years. But here's the part of your property that's going to be 15-year property, which is also known as land improvements. Here's the part of your property that's going to be 5-year property, which is going to be tangible personal property, things like light fixtures, things like that. And somewhere between 20 to 30%, depending on the property, location, a whole bunch of details, can be reclassified to this 5 and 15-year category, where those would be accelerated by itself. Like it would just depreciate over 5 and 15 years, which is shorter. So you'd have a higher depreciation expense. But really, the power of this since the Tax Cuts and Jobs Act of 2017 is bonus depreciation. So right now, bonus depreciation is 60% in 2024. So to kind of give an example of this, same $400,000 property, let's just say that 25% was reclassified in a cost segregation study to this 5 and 15-year property. That's going to be roughly $100,000. Now, if you're able to use bonus depreciation on that, 60% of that, you're going to get a depreciation expense in the first year of $60,000. So this is a non-cash, this expense only exists on paper. So if you go back to that example we had before, where you had maybe, well, 500,000 property, probably closer to 10. So if we just kind of take a zero off those numbers, you have $4,500 or $4,500 in expenses. Now you have $5,500 in cash flow, but now you have this massive $60,000 non-cash depreciation expense. Now you have a tax loss in that first year, $54,500. So that's substantial. Now, if you're a passive investor, that will either offset other passive income you have, or it'll be suspended, carried forward for future years. Can offset that. But if you're a real estate professional, now this can offset your active income. This is why they love to combine it with cost segregation and bonus depreciation. You get these massive losses that can significantly reduce your tax liability.
Hmm. Just to remind everybody, head over to Thomas's website. It is therealestatecpa.com/Thomas, therealestatecpa.com/Thomas. It's going to be a clickable link in the show notes. If you found some value in what we were talking about so far here today, do us a quick favor, share this with one of your investor friends. So, this cost segregation strategy, there seems to be a lot of balls in the air. At what point do you find that it's worth it? Is this worth it for a single family rental, or is it worth it more for those multifamily properties?
Yeah, that's a great question. So on multifamily properties, it's almost always worth it. Most investors that I've worked with have always wanted to opt for this. But when you get down to single family properties, in some cases it could be cost prohibitive. However, there's something that has came out recently over the last few years, and I mean recently, maybe the last 10 years or so, called a desktop study or software cost segregation study. And they typically do these on properties that are less than $1 million. But basically, what you do is you will input information into a software about your property. So the size of your property, square footage, amount of rooms, fixtures, things like that. And then that software will basically do the cost segregation study for you. So you're not actually having to bring an engineer to your property. They're not having to survey your property. They're not having to go and put the man hours into it. And that software will give you that study. and it will be approximately the same, give or take, depending on the specific property of what you'd get with a normal study. So we've seen those because they're usually, I think, less than $1,500. In many cases, I think you get one for as low as $600. We've seen them be profitable or be cost effective on properties that are as low as $150,000, and certainly on properties that are $500,000.
Hmm. And this is something that is accepted now in the industry, that the software, because it seems like you, or is this
Yeah,
something that gets caught in audits, or how does
yeah,
that?
Yeah, that's a great question. So traditional cost segregation studies, those have been around for a long time. The IRS approves of them. There's an entire guide on how to do those, actually. In fact, it's the right way to depreciate a property, but the IRS isn't going to come after you if you don't do it. Now, the software ones, there's a big concern around that for a lot of people. And a lot of the companies who offer these studies do offer audit support. So we always recommend, if you do purchases, get the audit support. One of the companies we were speaking to, I think it was last year in 2023, they had actually went through an audit. So one of their clients had gotten audited, and they were able to successfully defend the audit with their software, showing how it worked and everything like that. Now, part of the reason why they do it on smaller properties is because there's a lot less risk, right? And when you have a bigger property, there's a lot more components, there's a lot more things that could potentially go wrong. One of the companies does it on properties that are $600,000 or less, and then the other one does it on properties that are a million. And in certain instances, I believe they can go up to 3 million, depending on the situation.
Hmm. So I'm going to tackle a couple pretty big subjects here now. And we've been pretty much talking about rental properties up until this point, but a lot of people, when they get into real estate investing, they usually tackle wholesaling and fix and flipping. So you get these huge capital gains on some of these properties. Is there anything that we should be aware of that can mitigate that outside of the rental properties
The
as a
balance, yeah.
balance?
Yeah, absolutely. So wholesaling is typically going to be considered ordinary income. You're receiving fees in exchange for finding a property for somebody else, basically. And that is going to be taxed at rates up to 37%, just like you're basically running a business. So you have self employment tax, you have the federal taxes, and same thing very much for flippers. And when you're flipping properties and you're holding properties out for resale rather than for rent, it's considered inventory. Much like a car dealership has cars, they're not depreciating those cars for the most part. At the car dealership, they're holding it out for inventory. So when they sell a car, they're paying ordinary taxes on it, just like in the wholesaling situation. So in many cases, flippers will be subject to those ordinary tax rates as well. Now, the way to mitigate taxes on that is one way to do it is to consider establishing an S corporation. So before I get into this, I want to preface this by saying, don't ever put a rental property in an S corporation. A lot of downsides. But when you're flipping properties or you're wholesaling properties, if you do it in an S corporation, what the S corporation allows you to do is pay yourself a wage or salary. And then the profits are not, so that the salary will be subject to the FICA or self employment tax, whereas the profits will not. So, what some flippers or wholesalers will do, and same thing with real estate agents, they'll do the same thing. They'll have an S corporation, they'll have all their income from the wholesaling, the flipping, perhaps if they're an agent, all going into the S corporation, and then they'll pay themselves a salary and be able to reduce their exposure to the self-employment tax, which is 15.3%, up to, I believe, in 2024, it's around $163,000 of income. So that can save people tens of thousands of dollars per year just doing that.
That's interesting. Short-term rentals has been such a big thing for a lot of people.
Yes.
Is there any tax rules or intricacies that we should be aware of?
Yeah, absolutely. So short-term rentals have been really popular, and we're about to find out part of the reason why, in my opinion. If we go back to the real estate professional status and the fact that all rentals are passive, well, there's a carve out under the definition of rentals activity in the tax code. And that was originally intended when the rules were written back in the 80s for hotels and motels. It's become known by the real estate community as the short term rental loophole. It's called a loophole because you generally aren't able to do this easily with a single family property or a regular condo. But now you can thanks to Airbnb and VRBO. But if you rent your property out for an average stay or an average guest stay of 7 days or less, then it's not a rental activity. It's treated as another, just any other business, effectively. There's another exception too that's somewhat popular, and that's if the average stay is 30 days or less and you provide substantial services, which are things like daily cleaning, daily meals, tours, concierge, things that you would find in a hotel. If you meet one of those two exceptions, then a business. And with businesses, you don't need to qualify as a real estate professional to use the losses to offset your W 2 income. The problem is in most businesses, if you have a loss, you actually lost money. But here you have a single family residence, for example, the same single family residence as before. And now you have this massive loss from depreciation. And all you have to do to turn that non passive to offset your W 2 or active business income is materially participate. And you don't need to spend more than 750 hours. You don't need to spend more than half your total working time. There's 7 tests, but 3 of them are usually going to be the ones that matter for the vast majority of investors. And as you spend $500 on the property working on it, either that or you do substantially everything yourself, which means you're a one person show. You run the whole thing. Maybe you have some very little ancillary help here and there. And then the third one is you spend more than 100 hours and no one else spends more time than you. And that's by far the third one I just mentioned, by far the most popular because it's hard to spend 500 hours, at least from what I've seen, on a short term rental. But you could probably spend more than 100. And then you could also use cleaners and like have a repair person come down and do some things. As long as they don't spend more time than you, then it's non-passive for you. So this has been known as the short-term rental loophole because again, you could go around this blocker that the Tax Reform Act of 1986 put in and basically take the losses as non-passive without qualifying as a real estate professional.
Well, these all of these strategies that we've talked about here, this is why it's important to talk to a real estate investing tax CPA, somebody who is seeing this on a regular day. You mentioned you've helped hundreds of companies here now with this process. I would imagine that a general CPA, somebody who's just an everyday business oriented CPA, they probably don't have this level of expertise.
Yeah, they typically don't. The reason for that is they're looking at a wide array of different things very broadly. So they might be helping someone in manufacturing. They might be helping someone who has a small business. Maybe they're a doctor, maybe they're an attorney, but they don't ever dive deep into the real estate aspect of it. When it comes to the tax code, the real estate part is probably the most in depth or one of the most in depth and people just don't really they scratch the surface and never really dive deep into it. So a lot of times we hear stories like why isn't my CPA ever told me about this? And people are somewhat skeptical, so we have to start pulling out the tax code and the citations and all of that. But yeah, most generalists are not going to know this stuff, and if they do, if they are aware of it, they typically don't know how to properly apply it, which is sad because we've seen a lot of investors leave a lot of money on the table. I think one of our largest clients, we ended up saving like legitimately like $3 million for them because they had such a big portfolio and no one's ever told them, "Hey, you could do this." And yeah, it's unfortunate.
Well, I think one of the things that we've experienced and is the fact that, we're talking to more general CPAs. We kind of expect to have some sort of maybe strategy sessions or some way to discuss some of these things more in detail to make the best use of your time, our time, and everything with our acquisitions. And more times than not, that feedback just isn't there.
Because the problem with it is most CPAs, there's a few problems. So the first one is most CPAs are simply tax preparers. So you give them the information, they file your tax return, and they say, "I'll see you next year." And that's because they're very busy doing tax returns. They take on way too much work than they can handle, and they're always scrambling to get it all done. Another reason is so they're never giving you tax advice. It's kind of a different skill set. It's kind of like more consulting versus sitting in the background, and that's also partly because many CPAs, not all, are tend to be introverted, and I've worked with many who'd prefer just to sit behind the computer and never talk to anybody, and they're very happy doing that. There's nothing wrong with that. I'm just saying this is why a lot of people aren't getting the advice because the combination of just being too busy, not really knowing how to administer the advice, not diving deep enough in the tax code to even realize this stuff exists. So that's usually why you don't see tax advice being given to a lot of to a lot of taxpayers in general.
No, I really appreciate this. Before we switch into the rapid fire questions, is there a question or concept, anything that we should have tried to cover here today so far?
I think we were relatively comprehensive here in terms of the big picture items, the real estate professional status, the short-term rental loophole, how to play the passive activity loss game, just understanding even if you can't use reps, even if you can't use the short-term rental loophole, just investing in real estate, whether you're doing it passively or you're building your own portfolio, you're putting yourself in a tax advantage position. Those are the main concepts. And if you tack on just the long term benefits again of being able to refinance out and being able to 1031, I think If you're able to use those things, you're putting yourself in a very good tax position as a real estate investor.
Well, just one more time, it is therealestatecpa.com/Thomas. That's going to be a clickable link in the show notes. But if you're ready, Thomas, we'll jump into the rapid fire questions.
I'm ready when you are.
This will be an interesting one because from a CPA perspective, what lie do real estate investors tell themselves?
What lie? That's a good one. I think the biggest one is they think it's going to be easier than it actually is, right? They go to a seminar, they read a book, they watch a YouTube video, maybe they listen to a podcast, whatever the case is. And they say, oh, I'm going to buy a rental property and I'm just going to, rent it out and it's going to be passive. And the reality of the situation is real estate can be relatively passive, but it's not completely passive. There's some work to acquire the property. There's some work to actually maintain and perhaps renovate the property. Even if you're not doing the renovations, there's still coordination. So it's just it's not as easy as clicking a button on the mouse and buying a stock for the most part. So I think that's the biggest lie. People just think it's going to be too easy, easier than it is.
Do you have a book recommendation?
Yeah, so I read a lot of books. The one that I've read most recently that had the biggest impact is a book called 10X is Easier Than 2X by Dan Sullivan and Dr. Ben Hardy. They actually have a trilogy of books together, Who Not How, Gap and the Gain, and then this one. They're all excellent, but the 10X is Easier Than 2X really kind of it's more about identity and how to become the highest version of yourself. I think it's just been really impactful for me, and I can't recommend it highly enough.
If you could go back in time and give your younger self one piece of advice, what would it be?
Seek apprenticeships, learn from mentors, look at the lifestyle you want. All right. This is where I start. Look at the lifestyle you want. Who's living that lifestyle? What types of business are they in? What type of jobs do they have? What fields are they in? Then go find somebody to model and be your mentor, or perhaps go work for somebody in that space so you can learn it. That's what I'd recommend. I think that model of learning is just not quite prevalent these days. A lot of people are kind of funneled, for lack of a better word, into college. And there's nothing wrong with college. I think for some fields it's absolutely necessary, but for others, there's just better ways to learn. I think an apprenticeship model is something that I would tell my younger self to go explore.
What single strategy, process, or tool have you implemented that has had the biggest time saving impact to you or your business?
That's a great question. Zapier has been phenomenal in terms of being able to automate certain tasks that are routine. We also have an email system called Front that is also phenomenal, allows you to collaborate between people behind the scenes and also snooze emails. And it's relatively sophisticated from email management perspective. So I'd say those two probably big time savers.
Well, I really appreciate your time again, Thomas. One last time, it is therealestatecpa.com/Thomas. Therealestatecpa.com/Thomas. It's going to be a clickable link in the show notes, but it was great meeting you. You brought a ton of value to this episode, and I hope we'll touch base again sometime.
Likewise, thanks for having me. It's been an honor to be here.